Good morning. It is Wednesday, May 25th, 2011. This is Mark Boud from Real Estate Economics. Thank you for joining us for our weekly webinar series. Our topic this morning deals with the 11-county Bay Area, from Marin and Sonoma, Napa and Solano counties, all the way down to San Benito County to the south. We are going to share with you our information regarding the housing market, the overall transactions, distressed inventory, our modeled forecasts for the next 5 years in terms of housing supply and demand, as well as in terms of price appreciation. We'll also show you the current trends in terms of job growth, and there is actually job growth in this area, as well as our forecast for the next 5 years for the overall economy. And as always, we'll start with housing transactions. The most recent information that we have available is March 2011. As you can see, in terms of market shares, 17.9% of all transactions have been associated with foreclosures, properties being lost to the bank. Another 21.2% are associated with foreclosure sales, the bank selling those distressed foreclosed homes to new owners. Only 2.5% are associated with new home builder closings, and about 58% associated with resales. This is far different from a normal market atmosphere. Here's more of a normal market atmosphere in terms of distribution. We'll go back all the way to year 2006, where less than 3% of overall transactions were associated with distressed housing. Over 12% was associated with new home builder closings. That's more of a normal distribution, as well as about 85% associated with resales. In terms of distressed housing, this isn't the entire 11-county Bay Area, but it's most of those counties, most of those major counties, so we capture most of it. We track notices of default, foreclosures, and foreclosure sales. We take the cumulative difference between foreclosures and foreclosure sales to get an idea as to how much inventory is being held by the banks over time. And as you can see, we're right here in 2011 with about 8,000 units in inventory. That's a very high level of distressed inventory, but far less than it was at the peak year of 2008, where we almost hit 20,000. So we're less than half of where we were. We've eaten into that quite a bit, as there's been a lot of transactions in terms of distressed inventory over the past few years in the 11-county Bay Area. And we think that it continues to burn off. Despite the fact that the foreclosure rate remains very high in this area, the foreclosure sales rate is quite a bit higher. And that burn-off rate translates to this kind of a trend, we think, for the next 5 years in terms of the burn-off of distressed inventory that's being held by the banks. If you look at the overall annual construction patterns for new housing throughout the Bay Area, we're near an all-time low in year 2007 or 2011. However, if you add to that distressed inventory, it's not as low as it would appear. Actually, it even falls more as we hit 2013 and 2014. Despite the fact that we're building more new homes, we're burning off distressed inventory. And so the overall level of housing will remain, or housing supply should remain quite low, probably through 2014, 2015, even 2016. In terms of overall job levels, you can see the hit that we've taken during the past few years and our growth path for the next 5 years. You can look at it on a 12-month basis here with our 12-month forecast. Here's that positive job growth that I was talking about, where we've created about 30,000 plus jobs during the past 12 months from March 2010 through March 2011. If you look at the distribution of those jobs, most of them are associated with professional and business services, a lot of them associated with the health industry, as well as leisure and hospitality and information. Still losing jobs in government, still losing jobs in construction. However, this report for job change during the past 12 months is far better than it looked like back in March 2009 to 2010, where most industries were losing jobs at a very large rate. We're past that period. We're in the recovery stage. There will be bumps along the road in terms of that recovery, but we have established job growth, and it looks like that positive trend will continue. And here's that overall trend we see for the next 5 years in terms of job growth. This year, 2011, we think that we'll create about 41,000 jobs. Keep in mind that we're about 30,000 right now, and so 41,000 jobs being created for the entire year isn't too much of a stretch. We think it bumps along between 54,000, 66,000, peaks at 77,000 in 2015, and this is a fairly healthy economic cycle. This economic cycle will occur during a period of very little new housing construction, partly again because there's distressed inventory on the market. But we think that we'll hit a scenario around 2013, 2014 with very little new home construction, a increasingly strong economy, and very little, or the burn-off of distressed inventory, the depletion of distressed inventory by around 2014, 2015. And that spells stronger price appreciation during that and after that period. All of this translates into our housing demand and supply model. The green curve is our measure of overall demand. And as you can see in this market where there's a lot of job growth or a lot of job loss, you can see what happened during the dot-com bust with a lot of job losses. Then we grew out of that and had a positive cycle until this most recent recession, and now we're improving from that. The blue curve is overall supply, and you can see that supply is much more, I guess, stable. It does speed up during economic boom periods, and it does flatten during economic down periods as it is right now. But overall, this is a highly volatile market in terms of construction or in terms of overall demand, and it creates very wide swings in terms of price appreciation. You can see a little bit of that, these oversupply and undersupply patterns here. And here's our model associated with those wide swings in price appreciation. The blue curve shows where overall median prices have been, or where we think they're going for the next 5 years. The green curve is where we think prices should be. And the gap between the two measures either, and here is that gap, measures either a bubble or overvaluation. We had gross overvaluation as high as $300,000 on average per unit back in 2007 before it crashed, or undervaluation. Right now we think we're close to about $200,000 undervalued in this particular market. We're almost as unstable right now in May of year 2011 as we were back in 2006, 2007. It's just the flip side of the equation. And this has to be forced back to equilibrium, either by price appreciation or increases in mortgage rates or a combination of both. It's simply too unstable right now for that to last. It does mean that there is a window right now which is wide open in terms of purchasing at affordability levels that we have not ever seen in this market. Those who are able to purchase right now may very well experience a windfall as time goes on and as we go into the next appreciation cycle. And here's the beginning, the first 5 years of what we think is the next appreciation cycle, where we start out with a little bit negative in year 2011 overall. That's partly because of the North and the East Bay markets, which are still depreciating slightly. South Bay is actually doing quite a bit better, as is the Peninsula. But the overall impact is slight negativity this year in terms of overall prices. But we think that turns positive in 2012 and grows thereafter to an appreciation rate of 7% annually by year 2016. And here's what that leads to in terms of median price over time. Even by 2016, we're not nearly where we were back in 2007 in the peak, but we're approaching the level where we were in 2004. In terms of the long-term appreciation cycles, I wanted to show this for the entire state, that it is not abnormal for California markets to go into double-digit appreciation cycles. You can see that we went through that kind of a cycle back in the late 1970s. We did it again in the late 1980s before it crashed in the 90s. We did it again and hit double digits by 2000 before it began to dip after the dot-com bust. But because of very loose lending practices, we actually introduced a lot of artificial demand into the system and created 1, 2, 3, 4 straight years of double-digit appreciation. That was highly unstable and unsustainable, and the overall impact of that was a contribution to the financial crisis, where we dropped about 27% in price in 1 year, dropped almost 10% the following year. Now we're back at about even at the base of what I think is another cycle. We don't think this next cycle, shown by these pink dashed lines, will be nearly will be as dramatic as we've seen in past cycles. Part of the reason is we'll have regulation in place that prevents it from getting way out of hand. Nonetheless, most California markets are land restricted markets that experience these large swings in terms of price and value. This is what we think that overall swing looks like from now till year 2025. Now that tunnel gets dark after about 5 years, but if this follows similar patterns and similar correlations with the economy, then we think that this is a very good depiction as to what the overall appreciation cycle looks like during the next 15 years. And that is it. We appreciate you joining us this morning. If you want information regarding our consulting services, we offer that throughout the United States. You can either contact myself or my associate John Mulville. Regarding our online information tools, most of the information that's posted in this particular webinar is available online on our website, www.realestateeconomics.com. Feel free to contact Judy Duell or Sandy Rivera for those subscription services. Thank you very much. We hope you'll join us in a couple weeks. Take care.